Mic check 1001, 1002, 1003. I'm going to share the top three financial news in the market, for the week of May 25th. And the key takeaways, how it's going to impact the financial market and the stock market, and my thesis on a lot of movement, by the Trump administration. The first big news is Trump delays EU tariffs, and the markets rally. The key takeaway is, there's a reduced, immediate trade tensions because of tariff temporarily being removed by the Trump administration. And this action directly boosted investors' confidence and supported a short-term rally. This is a short-term because the uh, tariff threat is still looming around. And the second takeaway is, there's an increased optimism in the cyclical and export-oriented sectors. Industry like automotives, aerospace, and luxury goods that heavily relies on the EU and the US trade. They rebounded last week, and especially with odd stocks in the EU and the industrial sectors in the US showing strong performance. If you're in the industrial sector, a lot of equipment US manufacturing uses today heavily relies on EU supply. And the third takeaway, for the tariff tension between EU and the US is, there's still a huge potential for future volatility. While the delay sparked a positive reaction, the short-term, confidence in investors, they think about, okay, there's going to be a period of time, the tariff is going to be delayed, but still the threat is there. It is still around. It's not gone. And leaving some uncertainties, that could cause volatility leading up, to the July 9th deadline. The second news in the market is really about Nvidia. We know Nvidia stock uh, the kind of tanked, because of DeepSeek of China, showing that the AI sector, for the large language models, you don't need a lot of computer chips, especially graphic, processing unit GPUs being manufactured by Nvidia. Still, the key takeaway is, Nvidia has a really strong earning, although there are some challenges, from adverse countries, and the main takeaway is the tech and the semiconductor sector, they still have some nice tailwinds. Nvidia's blowout earnings highlight sustained demand for AI infrastructure, whether it's domestically and internationally. It's supporting a bullish sentiment in the semiconductor industry and the broader tech sectors. And the second takeaway for this news is you're still gonna see some headwinds from export restrictions because the tension between U.S. and China, not just because of the trade tension, but also of the geopolitical tension. Uh, Although Nvidia came up with the idea of having a H20 chip designed specifically for China, it tempered the rally, and brought some, optimism, but still you have questions about the long-term revenue growth from international market, especially for China, especially for the Southeast Asia. You still have concerns whether you're going to see a long-term revenue growth from that region. And the third takeaway is, AI momentum, for the past, months, weeks, and even years, couple of years, has been the main market driver. The narrative of Wall Street is all about, AI. And NVIDIA's result, reinforce that the AI spending is a structural tailwind, for the market, benefiting not only chip makers, but also cloud computing and data center stocks. And I want to extend about that. If you look at AI, there's a couple of sectors you should really look into AI stocks, not just manufacturers for the infrastructures, but also on the application side. Tesla, which is going to be the one of its kind, leveraging AI, especially on the vehicle side, trying to have, autopilot, auto-driving cars, and also for other sectors, healthcare, I encourage you to look out for those stocks that leverages AI in the healthcare sector. And also, on the finance sectors, the loans, and the underwritings, something like Upstart Holdings and SoFi and Palantir. Those are the stocks you should be looking for, for the future, and see how they respond to certain markets volatilities and news. And the third big news for the past week is the U.S. court blocks Trump's, sweeping tariffs, the liberation tariffs. The key takeaway from that is, uh, temporarily it brought some relief, for the global exposed business, particularly, something related to the importers and the global supply chain to the United States, leading to some, broad-based gains in manufacture and the consumer goods sectors, So that's what we saw. And the second takeaway is, the potential legal implications. The ruling may limit future executive tariff powers. So the tariff power has long been the power of the executive branch of the United States government, and by limiting what the government can do on the tariff, it reduces threat of sudden trade policy changes and improving the long-term investors' confidence in the trade stability. But in the short term and in the imminent term, there could be some, concerns, with regard to how the government is, especially the executive branch, respond to national debt. I'll come later to that, my thesis about why national debt matters and why Trump is doing whatever he's doing, uh, trying to deal with the national debt. And the third takeaway is short-term, relief rally, but in the long term, it's still unknown. We still have to be cautious in the long term. Well, the market, cheered for the decision. Obviously, you see the barrier of tariffs being taken down temporarily. The investors remain cautious about the future political and trade policy risks, especially, this is a lower court decision, and how that goes into legal proceedings and how the future turns out is still unknown. And potentially limiting how far this rally can extend. We don't know how long this rally is going to be and where we're going to see, for the next couple of weeks, for the SP 500. There are people doing, technical analysis on SP 500. I'm not a technical analysis guy. I don't believe it. It's a linear regression. So, anyways, um, in my cases, is for you to think about it is, we all know that national debt is a huge problem for the United States. And for the past couple of years, if you search, actually, I'm going to search with you. If you search national debt to GDP, and if you look at from the Fed database, you can see what the ratio looks like. So for the past couple of years, and this is what the national debt percentage to the GDP looks like. If you look at the level actually beyond the year of 2000, let's say 14, it has been more than 100%. What that means is the national debt is more than the GDP. We are generating more debt than what we are generating in terms of economic value, and that's a huge problem. And that problem, builds debt, further. And for us to deal with that, the U.S. government has long been, refinancing the debt. It's just like you buying the house, and you. What's good for the government, good for the people, is if you have a lower interest rate, so you can refinance the debt with much lower, with much relief and the ability to actually pay the debt because you refinance it at a lower interest rate. So if you buy a house for $1 million and it's at 7%, but instead you get a 2.3%, loan, and you can actually pay it better because the interest that you're paying is significantly lower. And that's a simple economic idea. But in the long term, what we see is currently there is no government, the Fed, all the Federal Reserve banks, and the Jerome Powell is not trying to cut the rate right now. And how you can push them to cut the rate is you have to create the volatility. You have to create the risk. You have to create uncertainties, for the market to deal with. So the Fed, can step into the situation and, lower the interest rate. By lowering the interest rate, not only you and me as average consumers, we get a benefit by doing that, buying houses, refinance our loans. But for the government, it's a huge relief because now they can pay back the debt better because the interest rate is low. You can refinance the debt. Otherwise, if you don't have a lower interest rate, no need to refinance debt, and you can pay that debt back because you need lower interest rate to be able to pay back that debt. That's my thesis. That's my and this, a lot of people say is they believe Trump was trying to force a card to let the Federal Reserve to cut the rate. That's our thesis, but there's still a lot of unknown. What I want to tell you is, uh, regardless of what the marketing news looks like, regardless what your uh, investment strategy looks like, what you should really consider is a long-term investment, mindset. If I were you, this is not a financial advice, but if I were you, two things I would do is, only buy the stocks that have a strong understanding of their fundamentals. They have a strong leadership year by year. They're delivering result. That's the type of stock I'm looking to. If you work for the health care sector, look for the companies, look for the providers that has unbeatable service, strong leadership, delivering result year by year, not so much uncertainties, and strong leadership being maintained for the past couple of years. That's a stock I'm going to be picking. And if you're not interested in the stocks, I would say, go find the index fund that you can trust, right? SP 500 has been proven that it's the best investment, one of the most safest investment. Those are areas I'm going to look into. Uh, by history, there are also some risky assets, like cryptocurrency. But again, it really depends on your flavor. If I were you, I'll buy into my convictions. I'll buy into the long-standing success, something like a SP 500 tech sector. And yeah, uh, that's the news I have to share for the week of May 25th, top three financial news. And I look forward to chat with you again. Bye.